change the video. What do you think of share and what do you think of equity? By the end of the video, you will come to know the meaning and what is all used for.
Now, understanding the share and equity in finance. It's just an introduction. What does share means? Share is nothing but the amount the investor are investing in a company by, and it gives the part of ownership. And equity. What do you think of equity? Total ownership interest in a company, including the share capital and reserves. Both are like the components of a company's financial structure. Now, they are the very backbone helping the companies to grow and attract the investors and ensures a long-term financial stability. Now, moving on to the next slide, definition of shares. What is share? Share, you can easily understand what you will normally think of a share. Share means I will explain you in a real-time example. For example, you and your sister are there in a family. Your parents usually buy a packet of biscuits where it containing 10 pieces. You will usually take 5 pieces and the next 5 pieces will be for your sister. Like just as I said, the same thing. It is a share. What do you call it as? It is a share. Basically, it is a share in within your family. But when it comes to a company, it is the share which represents the ownership in a company and entitling the shareholder to the appropriation of the proportion of the corporation assets and earnings. And there are a few types of shares which are basically common shares and preference shares. A common difference is like common shares are normally which have an voting right, and preference share doesn't have any voting right. And we will be letting know the detail in the furthermore slides. And issuance of shares. Issuance means you can buy shares, you can sell shares, and you will be the investor of a company. And companies usually issues new share to raise capital. Basically, as I said like before, it is the backbone of the company. Types of share. There are three types of share, which is common share, preference share, and convertible shares. Common shares, as I said before, you will be getting the voting rights, and in preference share, you won't be getting the voting rights. But what's the benefit of having preference share is you will be having a fixed dividend getting every time when you get a profit. But in common share, you won't be getting the fixed dividend. It might be changing according to the profit and losses of the company. And now, what the purpose of having the voting rights? You know something? When you are in a country, the voting rights is a very important role to select a president, prime minister, your chief minister. The same way. Common, like when you have a common share, you will be having the voting rights where you can choose the person who has who the company have to be handed over so that the company runs peacefully at a profit. Now comes the convertible shares. Convertible shares are nothing but a specific number of common shares which can at a later date can be converted into common shares, and each share meets the investor needs. Now comes the types of share capital. There are three types of share capital, which is equity capital, debit capital, and preference shares. Equity capital are raised by issuing shares, and debit capital is nothing but it's like a borrowed money that must be paid with an interest. It must be definitely paid. And preference share. What do you think of preference share? The shares that provides the dividend before the common share. Okay. As I said before, when you're purchasing preference share in a company, whatever the company, it may be in profit or in losses, they must definitely pay you. But if you have a common share now, you cannot be receiving the profit when the company is in loss, and you won't be given that much preference. That's why it's called preference share. Next, moving on to the next topic, it's like how to raise a share capital. When you're running a company, you must raise share capital. That's when you can make your company grow and make your company in a long-term financial race. Like how to raise a share capital. It's just in a simple five process, which is basically first step, you have to identify your needs. What all funds do you need? For that, you need to identify, you need to determine it. And the next thing is you must choose the capital raising method, whether you're going for crowdfunding, whether you're going for other all methods. The next third step is like you have to prepare a financial document which must say all your truthful information about the company. And next comes the thing which you need it to present it to the investor. If you present it in a very good way, and if your company is in profit, and if your company shows a very good potential, and definitely the investor will show some attraction towards you. And the next thing is closing the deal. After you get the proposal, after you submit the proposal to the investor and they finalize the deal. Next, strategies for investing in shares. While investing, a few smart strategies are required, and which makes a big difference. Diversify your investment. You must not be putting your share in only one single platform, not only in a single company, but you should diversify your share and you should work smartly. And you must invest it for long term to benefit from growth. The same way, if you plant a if you plant a seed today, do you see any growth by the next day? No, it takes years, it takes days, it takes months. The same way, you have to invest and you must wait a little long time so that you can be benefited from the growth. And now comes the third last point, research and analysis. Research must be made. You can't blindly trust anyone in the share market and you can't just give away your money because it's your hard earned money. So you must be aware where your money should be invested. Next comes equity. Understanding equity is nothing but what is equity basically? Equity is the ownership of value of an asset, which is often represents a share in a company. It reflects the residual interest after the liabilities are deducted. It shows the true value of the company. And it must be the equity financing. You through this equity financing, you can raise the company's funds without borrowing. And the next one is equity stake. Equity stake is like the shareholders' portion in a company and which decides the profit and the voting rights also. Now comes the components of equity. Components of equity are of three types, which is common stock, preferred stock, and retained earning. Common stocks are like the ownership in a company, and preferred stocks are like the it has a fixed dividend where you have to pay it definitely. And retained earning. Retained earnings are nothing but it is the accumulated net income distributed as dividend. Now, what are the importance of share in equity? The value of share and the equity must be defined according to the capital growth. Capital growth refers to the regular income through dividends. And the market liquidity means allowing the investor to easily buy and sell your share at any time. And the flexibility encourages financial participation. Valuation of shares in equity. How do you evaluate a thing? For example, if you're buying something in a market, it is usually like if you go to a market and buy 1 kg of onion for 50 rupees. So the onion is valued at rupees 50. The same way, your shares and equity must be valued, right? And what all the methods for valuing it? Market capitalization, where you can actually multiply the uh, share price by the total number of outstanding shares. And intrinsic value. Intrinsic value is nothing but the discounted cash flow models to compare with market price. And equity ratio. Equity ratio is nothing but the debt equity and return on equity to access the financial health. Now comes the risk. Whatever product or whatever service you may take, you can see some risk. As I say, always there must be some advantages and disadvantages also. There cannot be a product or services without any zero risk. There are risks and risk like investments also comes with risk like market volatility which may cause the share prices to rise or fall quickly, and the dilution of shares are nothing but the poor management can reduce the share prices and the management decisions. If the management is poor in taking decisions, you can see that it can adversely affect the share value and making it essential for the investor to monitor the company's governance and performance. Now, let's get into the next topic of impact of regulatory environment, which is security regulation. Regulatory bodies oversee share trading to protect investors and ensure a transparent market practices affecting the share prices and equity and transparency. And corporate governance builds trust and tax law influences the attractiveness of shares and the overall equity value. Next, together we can create a safe and a stable investment environment. What are all the future trends? As I have been explaining the shares and equity for such a long time, you must be aware of all those stuff also. Like what is the future? What is the future of share and equity? The future looks exciting. What is? Because the rise of technology, the technology has been building, blockchains have come in place, and the cryptocurrencies have been doing a great job, and stock markets are good, and sustainable investment. You can actually invest it for the growing focus on ESG factors and increasing the retail participation through digital platform. These innovations making investing easier and more transparent. Now the example of share market. Stock markets are where equity tradings are made. For example, in India, we have NSE and BSE, which are globally NASDAQ and NYSE. And market indices like Nifty and Sensex help to track the performance of leading companies. You can actually visit these websites and online and you can check it before investing. You can get a knowledge of it. Now, coming to the conclusion, significance in finance. What are these playing a very important role is because shares and equity, as I said before, they are the backbone of a company growing. So through this, we can see that capital has grown and investment diversification have been made while posing various risks and opportunities. And informed investment and like a clear understanding of share and equity with sound investment strategies are a great partnership to win in the thing which you are investing. And you must have a common risk awareness of it before you invest in anything, and be aware of investing in something. Be get a knowledge, talk to many person who are very professional in it. Thank you so much and have a great day.